Have you noticed something strange happening in the crypto world lately? For years, one of the biggest selling points of stablecoins was simple. You could park your money in digital dollars and earn 6%, 7%, sometimes even 8% interest. It felt like a savings account from the future. Faster than banks. Available 24 hours a day. And paying yields that traditional banks could not match. But something just changed that could quietly end that entire era. The U.S. government finally legalized and regulated stablecoins through a law called the Genius Act. But at the same time, they removed one of the biggest incentives people had for holding them. The interest. The yield. The easy passive income that made stablecoins so attractive. So now the question I started asking myself was this. Did the government just make crypto safer, or did they turn it into something completely different? Because if stablecoins are now regulated like banking products, but without the high yield, then we may be watching the moment crypto officially becomes boring. And if you are an investor or someone who holds digital assets, this shift could completely change how the crypto economy works. Before I dive into the story, make sure you subscribe to Dave Invests Smart, because on this channel I break down the biggest financial and economic trends shaping the future of money, so we can understand what is actually happening instead of just reacting to headlines. Let me start with a simple question. What exactly is a stablecoin? A stablecoin is basically a digital token designed to stay equal to $1. Instead of the crazy volatility you see in Bitcoin or Ethereum, these coins are supposed to remain stable. One coin equals $1. The way they do that is by backing each token with real assets like cash or short-term U.S. Treasury bills sitting in reserve. That design made stablecoins incredibly useful inside the crypto ecosystem. Traders used them to move money between exchanges instantly. Investors used them as a safe parking place during volatile markets. And eventually, something else happened that really caught people's attention. Platforms started offering yield. If you deposited stablecoins on certain platforms, they would lend them out or invest the reserves and share the profits with you. Suddenly people were earning 6% or more on digital dollars. At a time when bank savings accounts were paying almost nothing, that looked incredibly attractive. But this also made regulators nervous. Because from the government's perspective, something strange was happening. Companies were effectively offering interest-bearing dollar accounts, but without being regulated like banks. And that brings us to the law that changed everything. In July 2025, the United States passed its first major crypto legislation focused specifically on stablecoins. It was called the Genius Act, which stands for Guiding and Establishing National Innovation for U.S. Stablecoins. This law created a formal regulatory framework for stablecoin issuers. Instead of operating in a gray area, companies issuing dollar stablecoins would now have to register with regulators and follow strict financial rules. Only approved institutions, such as banks, credit unions, or licensed non-bank issuers, supervised by regulators like the Office of the Comptroller of the Currency, are allowed to issue payment stablecoins in the United States. The law also introduced strict reserve requirements. Every stablecoin must be fully backed by high-quality liquid assets, such as cash or short-term treasury securities. That means if a company issues $1 billion worth of stablecoins, it must hold roughly $1 billion in safe reserves. This rule was designed to solve one of the biggest fears regulators had about crypto. What happens if everyone tries to withdraw their money at the same time? By forcing stablecoin issuers to hold real liquid assets, the government essentially turned these tokens into something much closer to digital cash. But the most controversial part of the law involves something called the Prohibition on yield. Under the Genius Act, stablecoin issuers are not allowed to pay interest or yield to users simply for holding the coins. That rule may sound small, but it changes the entire economic model of stablecoins. In the past, companies could attract users by offering high yields, funded by lending programs, trading strategies, or reserve investments. Now those payments are prohibited. And the regulators made it very clear that they are watching for creative ways companies might try to bypass the rule. In February 2026, the Office of the Comptroller of the Currency released proposed rules implementing the law and reinforced the prohibition on yield payments. The rule specifically warns that issuers cannot pay interest directly or indirectly through affiliates or related third parties just for holding stablecoins. In other words, the government is trying to stop stablecoins from behaving like high-yield bank accounts. And when I first read this rule, I realized something interesting. The government did not just regulate crypto. They reshaped its purpose. For years, stablecoins lived somewhere between banking and crypto speculation. They were used as trading tools, but they also acted like digital savings accounts. Now regulators are pushing them firmly into one category: payments. The Genius Act essentially treats stablecoins as digital payment infrastructure rather than investment products. Think of them more like digital cash that moves instantly across the internet. You can send them globally 24 hours a day. You can use them for cross-border payments. You can settle transactions on blockchain networks. But you are not supposed to earn passive income just by holding them. And that brings us to the big psychological shift happening in crypto right now. For a long time, the crypto industry sold itself on three big ideas: decentralization, high returns, freedom from traditional finance. But when you look at the Genius Act, it moves stablecoins much closer to the traditional financial system. Issuers must be licensed. Reserves must be audited. Anti-money laundering rules apply. And yield payments are restricted. Stablecoins are starting to look less like crypto experiments and more like regulated banking products. Which raises a fascinating question. Is this actually bad for crypto? Or is it the moment crypto finally becomes legitimate? Because when regulators step in, something important happens. Risk usually goes down. But excitement often goes down too. The Wild West era disappears. The industry becomes more stable, more predictable, and more integrated with the traditional financial system. That may not sound exciting, but historically, it is how financial technologies mature. Think about the early internet. In the 1990s, it was chaotic, experimental, and full of risky startups. Over time, regulation, infrastructure, and big institutions transformed it into the modern, digital economy. Crypto may be entering that same phase. Stablecoins are no longer just tools for traders on crypto exchanges. They are becoming a regulated form of digital dollars. And that transformation has huge implications for the future of finance. For example, stablecoins backed by Treasury reserves create new demand for U.S. government debt. Every time someone holds a dollar stablecoin, the issuer may be holding U.S. Treasury bills behind the scenes. That means the growth of stablecoins could actually strengthen the global role of the U.S. dollar. At the same time, banks are watching this development very carefully, because stablecoins could become a serious competitor to traditional payment systems. Imagine sending money globally in seconds, instead of waiting days for a bank transfer. Imagine businesses settling transactions instantly, instead of relying on slow financial networks. That is the long-term promise of regulated stablecoins. But the price of that promise may be the death of easy crypto yield. The days of parking stablecoins somewhere and earning 8% interest might slowly disappear as regulators close loopholes and enforce the Prohibition rules. Some platforms may still try to generate rewards through complex structures or third-party lending systems, but the regulatory environment is clearly moving toward lower risk and lower returns. In other words, stablecoins are becoming boring. But boring in finance is not always a bad thing. Boring usually means safer. And safer systems tend to attract larger institutions, larger capital flows, and eventually broader adoption. So when I look at the Genius Act, one do not see the end of stablecoins. I see the beginning of their transition from crypto experiment to mainstream financial infrastructure. And that shift could reshape how digital money moves around the world over the next decade. But it also reminds me of something important about investing. Whenever a new technology becomes regulated and institutionalized, the easy money phase often ends. The early adopters who benefited from high yields and wild innovation give way to a slower, more stable system. Crypto may still innovate. New financial products will appear. But the era of easy stablecoin yield is probably fading. And the era of regulated digital dollars may just be beginning. If you found this breakdown useful, subscribe to Dave Invests Smart, because my goal with this channel is simple. I want to help you understand the big economic shifts shaping the future of money, so you can stay informed and make smarter financial decisions while everyone else is just reacting to the headlines.